Here are my top 5 Vanguard funds I think are possibly the best you can invest in from right here in the UK. As I'm sure you know, there are thousands of different options out there, individual companies, ETFs, mutual funds, REITs and so on. So to save you some time, I've put together 5 of my favourite funds and we'll be discussing why it's something I personally invest in. I'll also go over the logic and thought process about why I think these funds are good options and what I look for when investing. And hopefully this may help you when deciding what to go for. This list is in no particular order, so let's jump straight into it. First up is one of the most popular funds Vanguard offers, as well as being one of the most famous stock market indices in the world. This ETF tracks the S&P 500, so some of the biggest and most well-known companies based in the US. Many of the companies on this list are the best in their field and do business all over the world. These are companies like Alphabet, Google, Amazon, Microsoft and so on. At a high level, this fund tracks 500 different companies. It has a low ongoing fee of 0.07% and has over $30 billion worth of investors' money poured into it. To put this into perspective, if you were to invest £100 into this fund, your charges would be 7p per year, so it's exceptionally cheap. Obviously this doesn't factor in other fees like your platform fee, etc. But if you buy somewhere like Trading 212, you could avoid the platform fees altogether, so it's definitely worth checking them out. This fund is passively managed, and that means there are no fund managers trying to pick the stocks in the portfolio. It just tracks the companies in that index and allocates the funds depending on their market weight. The good thing is that it's like a basket filled with baskets. If one company is performing badly, it's okay because the other companies may be performing better, which will help balance the performance overall. The larger the company, the more the fund buys. If you go online and look at the top companies, they'll have the largest weighting in the index. Apple, for example, will have the largest share of these funds, which is around about 6.9% at the moment. If Apple suddenly becomes worth less than say Tesla, then the fund would be adjusted and so on. Why is this fund a good option and who might this be for? This fund is universal and you can't go wrong investing in this fund regardless of where you live. This index has proven itself time and time again to deliver great results. You can go online and just see its past performance and how well it's done over the long run, which is what you need to look at when investing. It's got a wide diverse range of companies, many of whom are leaders in their space. It makes up a huge amount of the investable world in the US. You may not know this, but your current pension pot or other investments have probably made their way onto this index somehow. The next one on this list is the FTSE 250. I know the more common choice would have been the FTSE 100, but picking the FTSE 250 fund is an interesting choice for a variety of reasons, which we'll get into in just a moment. This fund has 251 stocks and an ongoing cost of 0.1%. It contains almost £2 billion worth of investors' fund. Now the FTSE 250 is the next 250 companies after the FTSE 100. So to be clear, the FTSE 250 is not the FTSE 100 and then the next 150 companies, is just the 250 companies after the FTSE 100. So this fund doesn't contain any of the FTSE 100 companies inside of it. And this can be a positive thing for a few different reasons, and here's why. By its nature, the FTSE 250 will have much of the smaller, less well-known companies, but these companies do have the ability to grow much faster and perform better than the wider stock market. The UK is home to some of the most exciting and innovative companies that can grow up to 40% a year versus the large companies in the FTSE 100, which won't have as much growth. So it's certainly worth having your hand in this basket of funds in case you find a company that starts to grow quickly. As with the other funds, this is all passive to you as the investor. There are no active managers. If you check online on the market weightings of the companies in this fund, what you'll see is that there is much more of an even spread. No one company makes up more than 1.5% of the fund's value. Near the top of the list, you'll see companies like Alliance Trust, Avast and EasyJet, for example. The good thing here is that you're not just relying on a few big hitters like with the other index fund, and the funds weighting in the FTSE 250 are a lot more evenly spread out. Now, why is this a good option and who is this for? It's good to have some exposure to the smaller companies with the ability to grow, and that's great for us as an investor. Most of the time, investors will want to only focus on big tech companies in America, but having diversification is extremely important. It means we're covered from all angles. And you never know, you may come across a new and upcoming company that shows a large amount of growth. The Vanguard US Equity Index Fund is next on the list and is a giant for a couple of reasons. This fund invests in the entire US stock market rather than just the top 500 companies that we've just looked at before, which means it also includes a lot of the smaller and more dynamic companies in the US that have the ability to grow really quickly. And that in of itself can be exciting for many reasons. This fund tracks nearly 4,000 stocks with an ongoing charge of 0.1% per year and has £1.3 billion invested inside of it. What's amazing about this is that the fund just reflects the Vanguard founder John Bogle's key principle in that you should just own the whole market. A really famous saying he has is don't look for the needle in the haystack, just buy the haystack. And this could be useful as you could buy an up and coming company while it's still cheap to do so, which could give you massive returns if the company grows. In the US, US, you've got a similar fund that's the famous VTI ETF, and this fund comes as close as you can get to this one, but it allows investors here in the UK to get invested as well. Now, why is this a good option and who's this for? Just like the S&P 500, this one is another universal one. You get exposure to every public US company from huge to small. The good thing is that you benefit from the growth in the economy. At the same time, you're putting yourself in a position to benefit if some of the smaller companies do well and grow, and often they can accelerate quickly, leading to better returns. If you look back over the years at the stock market indexes, you'll see that smaller companies have tended to do better over the long run. However, at the same time, they can be volatile too when compared to the more established bigger companies. The bigger companies can often provide stability but smaller growth, versus the smaller companies which could explode in growth if it becomes successful, and vice versa. So having the best of both worlds with big and small company gives you a great balance. So it's an ideal situation to put yourself in. The fourth one on this list is the FTSE Emerging Market ETF with the ticker symbol of VFEM. This fund is a little different from the other ones mentioned on this list and is going to other territories beyond the US and the UK. It features some companies based in China and Taiwan. If you take a look online, you'll see many giant companies like Alibaba and Infosys, who all do a large amount of business and something worth keeping your eye on. This fund contains 1,873 stocks and has an ongoing charge of 0.22%. It has $2 billion worth of assets included within it. This fund is good because it looks at the emerging markets, and it's always been a place for investors who enjoy a little more risk. In the smaller economies, there is a greater chance to have better growth and more returns over the coming years, and could even beat the more developed indices in the UK and the US. It's important to remember the emerging markets feature countries like China and Taiwan, who boast very successful companies as mentioned before. China's GDP is on the rise and makes it a big part of the global economy. Long term, there are some huge opportunities in the market. So why is this a good one and who's it for then? Anyone who thinks the emerging markets can potentially outgrow or outpace the US and Europe might want to have a look here. And also those who don't want to overweigh themselves too much by putting all of their eggs just in the US market. And this is easily done if you end up with, say, the S&P 500 fund, some life strategy, and even a global index fund. And what often happens is that you become overexposed to one market and you'll suddenly find the majority of your portfolio is US based. And while that is fine, none of us will know the future. So diversification is a good option, and this expands our horizons beyond the US and Europe. And finally on this list is probably one of the best investing funds you can get, the Vanguard FTSE All World UCITS ETF with a ticker symbol of VWRL. It's one of the best funds you can invest in because you've got everything inside and it's extremely well diversified. As the name suggests, this fund invests in the entire world, from very small companies to the really big ones, and from the US all the way through to the emerging markets. This fund has almost 3,771 stocks inside and has an ongoing charge of 0.22% and has over $8 billion worth of investors' funds inside of it. This one is popular for very good reasons. If you look inside this fund, you won't be surprised to see some of the most famous companies in the world, because just like the other funds we've spoken about, this is passive and index linked, so it's allocating its funds again based on the weight or the size of the company. Therefore, if we have a look here, we'll see that the largest names in the fund pretty much match the S&P 500. However, you do start finding a few other names like TSMC that find their way onto this list. Why is this fund good and who's it for then? So if you want to invest in a single fund without having ever to worry about how to invest in the US, the UK or elsewhere, this could be the one for you, because you pretty much own the whole world, which is a popular investing strategy, and it takes John Bogle's philosophy to the next level of literally owning the entire haystack without leaving a single thing out. As the world economy grows, your wealth will grow with it, and although there'll always be some bad times along the way, recessions and corrections, on the whole the market is getting larger, companies are becoming more profitable, and by investing more you get to make sure you have your fair share of all that growth. If I wasn't too interested in the stock market or I didn't feel comfortable building my own portfolio, I would probably just invest in this one and stick with it over the long time horizon. And the sooner you can get started with investing, the better. Remember that it's up to you to work out where to invest your money. All of this is just my opinion, and really we can never predict where growth will come from over the next few years and decades. So how you end up choosing your funds or shares is down to you. I hope you enjoyed today's video, and if you're interested in learning more about Vanguard, you might like to check out this video here. Thanks for watching and see you next time.